Well, good morning, Bob.
Good morning, Bill.
This is FNC's Morning View. It's a bright and sunny Monday morning after Easter.
That's all good.
So
now you got lots of chocolate in your system. You're ready to go.
Lots of chocolate, lots of sugar, a big run this morning. We're all good.
Oh, that's great.
So let's talk about this morning the different players in the mortgage process and their different motivations. We're talking about how people act and how they behave. And so let's first talk about buyers and sellers.
Well, you know, in the media, if you read the media over those last several years, you basically get the impression that every player out there in the mortgage business is either a vulture or a victim. You know?
Or both.
Or both.
It depends on the situation.
And I think it helps to understand.
Have you been both?
Hey, I'm a
You've
good
been
guy.
You've been a victim and not a vulture, right? Okay, all right. An economist, no less.
Right, exactly.
Well,
So,
I thought
you know,
had
we
two
stand
hands.
back.
I thought you had two hands. You're a vulture and a victim.
I just want to keep my hands on the table.
Okay, all right. So let's talk about the buyers and sellers.
Well, you know, and I think that the behavior of the buyers and sellers varies, obviously, in a down market or an up market. You know, I mean...
How so?
Well, think about it. If the market is climbing up, you know, it's going up and prices are elevating like it did.
Rising tide.
Then, you know, the sellers are sitting back and saying, well, how high can that price be bid up?
Show me the money.
And so they're looking for the highest price. But in a down market, they're just saying, please, please, somebody buy this thing.
They just want to basically want a trade to occur.
Exactly. And you know, and they're willing to drop that price or whatever is necessary to make that trade occur. And
So basically, if you're a real estate broker in that transaction, when markets are going up, you want to extract. You're representing your respective party, whether it's the buyer or the seller. What you want to do, since you're paid a percentage, you want to extract essentially all you can out of that transaction.
Exactly. You want that price to be as high as possible because you get a percentage of that trade.
And on the flip side of that, if prices are going down, you just want a transaction to occur.
Right. So if you're representing the seller in an up market, you know, you keep wanting them to raise the price, raise the price, raise the price.
Take bids almost.
Exactly. And then the down market, you're constantly convincing them that they need to really lower the price.
This is a good deal.
Yeah, we need to take this deal.
Exactly.
Because otherwise you don't get anything.
And so people have different incentives.
Exactly.
Well, the bank has got different incentives. And so let's talk about rising markets and underwriting. Both. Let's take the loan officer's perspective, and let's the mortgage broker, the loan officer, and the process and underwriter in that different scenario.
Right. A loan officer, you know, is trying to do a deal. You know,
they get paid when the deal happens.
Exactly, and so they want the value on the house to be up enough to make the deal happen.
But they don't care if it's any more or any less, just so it's sufficient.
As long as it meets that criteria, they're good. Okay,
and they can close the loan.
And so that got into a lot of issues during the boom, where the people were worried that the loan officer was trying to convince the appraiser, for example, we just need a little bit more here, you know, to get that up to...
Because loan officers got paid up front.
Exactly.
They got all their money up front, and yet the bank's risk and the investor's risk was over the term of the mortgage.
Right, exactly.
But if I'm a loan officer, I just want a deal to occur. I want to get everything I can through processing and underwriting, get them to sign off, and I'm good to go.
And during the boom, I think that extended throughout the bank. You know, everybody was looking at volume. Let's get this volume through because they, you know, as they process that, because the incentives for the bank were not probably what we would want. We have a little moral hazard there, right? Because
we keep kicking that term around. Let's talk about what moral hazard is.
Well, I mean, the incentives are such that you might choose to do something that is not in the best interest in the long run.
But it might be in your best interest in the present,
exactly.
the present time.
And that's where we constantly run into issues. If the person making the decision has incentives that are different than what's best for the institution, then you might get some little problems going on.
Such as everybody being compensated on the current profits and the current production as opposed to the long-term performance of those mortgages.
Exactly, and the banks were thinking, well, you know, we're gonna do this deal, but we're gonna pass that on to the investor, and they're the ones that are going to take the ultimate risk.
So we're not going to worry about
it.
We're going to take that mortgage. Sure, it's an originate to sell model. So essentially, the institution originated the loan. everybody at the institution got paid up front. They may have gotten a little carry, but mainly they got compensated up front. They took that and moved it off their balance sheet into a trust. The trust that issued bonds that were backed by those mortgages, and really those investors that bought those bonds are the ones that got the real risk over the term of the mortgage.
Right. And we were up in New York last week, and we were talking to traders, we were talking to rating agencies, we were talking to investors, and you know, they're sitting there saying, what is going on with our country right now that we're not letting people take responsibility for the decisions that they make. Okay, we've got all of these programs that are being instituted, some by the government, some by the courts, that are basically giving a lot of these borrowers who may have overstepped what they knew was the right thing to do, and sort of giving them a free hand on this.
So I'm a borrower, and I was a victim, in essence. That's what I'm saying. I'm a victim because you made me this loan. You didn't do all the proper disclosures. I really didn't realize what I was getting into. Even though I got the money, you gave me the cash, I signed a promise to pay over a future period of time, and you gave me the cash today, I was a victim because you shouldn't have done that. You should not have given me the money.
Right.
Under those terms and conditions.
Right. I'm the bank, and I should have been your parent.
And the bank didn't care.
Right.
They were passing it to the investor.
Exactly.
And the investor thought everything was good because the bank was underwriting to the appropriate procedures and that sort of thing. So it was all taken care of. What we have is a pricing issue.
Yeah, well, it's not. Yes, it is a pricing issue, but you know, in terms of the structure of the whole market, there has to be some process and some institution that everybody can rely on in terms of property rights. Okay, so if I make a commitment and then I'm excluded from the repercussions of that commitment, that creates another moral hazard.
Well, it does. And you were excluded historically two ways in the mortgage market. The first way you were excluded is you were excluded because banks shared credit data through credit repositories.
Right.
And another institution could ping that credit repository down the road and say, you know, Bob, you really did not pay your mortgage, and so that's a problem. The second way is there was a social stigma that if you went bad on your debt, you did not pay as agreed, at least historically in this country, that was a big social really a social hazard. You faced ridicule for being a deadbeat.
Exactly, and a lot of that seems to be going away now, because if I was a victim, then it wasn't my fault.
Exactly.
You know,
so somebody just took advantage of, the big bad bank took advantage of you. They gave you money you shouldn't have had and didn't need.
Right.
And you, of course, took it.
Oh, I needed it.
and you... Well, I thought economists didn't need it.
No.
I thought they kept score about
other monetary. I've got to have that sports car.
Okay, all right. So probably two, right? One for each hand.
Exactly.
Okay, all right. So anyway, essentially, there was this big social stigma. If you went bad, and we shunned you as a society and a community. But now you took the money that the bank should not have given you, and because you gave the house back because it was severely underwater by 20% or more, then it's okay.
Yeah.
Things have changed.
Right. And those bad vultures are now having to deal with that, right? Those investors, you know, you know, and it's funny too, because if the investor happens to be a wealthy investment banker, then it's okay for them to lose, right?
But if it's average Joe,
if it's the retirement fund,
right,
you know, that invested in those, well, that's a different thing, you know. So which type of vulture are you?
Well, and let's bring this home. Would you, listening out there, if you were more than 20% underwater, let's make it real. Let's say you owe $800,000 on your house. You were in one of these markets in California. It sounds like a lot, but a lot of these houses in California that were priced $500,000, $600,000, $700,000 are your generic tract house.
Right, exactly.
And you've got $800,000 debt, and now they're at $500,000. They're worth $500,000, and you say, it's going to take me forever to get out of this hole. Would you give the keys back and walk away? That's what we're talking about. And if you did that, an economist might not make that much money, I don't know. But
no, it's way over our
if they did that, then would your friends, would they shun you and ridicule you for doing that? And I think probably that has changed in America. That's a big deal.
It is, and you know, I mean, and there are different categories of buyers too. There's some buyers who could afford to make that payment every month
and still walk away.
And still walk away. And there are others who, because of
those are strategic defaults.
Right, and others because the adjustable rate mortgages that they got into at these teaser rates have kicked up, and they no longer can afford to make those payments.
Well, so some default because they choose to.
Right.
Some default on the basis of economic reasons. They've lost their job and they cannot just legitimately pay their mortgage. And some default or need to default or have to default because of a financial contract, which is the example you just talked about.
Exactly.
In all cases, do you think there is a stigma associated with default in America?
I think there's less now than there has been historically. I think that it's happening so much, it's so broad, and there's been so much in the press about everybody, all these people being victims of the inappropriate lending practices of the bank, that it's much less of a stigma today. And in terms of lending, it appears that many lenders are going to, after about 3 years, be willing to lend again.
Well, if you have a lender that's willing to do a principal reduction, a principal write-down,
do it now.
Do it now. Well, this has been FNC's Morning View. I'm Bill Rayburn with Bob Dorsey. We hope you have a fantastic day.